Yeah, it certainly seems like there's a disconnect there. And yet a lot of that comes from the simple fact that the economy is not stocks and stocks are not the economy. You have obviously within the indices, which is how most people think of stocks, you have drivers within that, and it really depends on what happens within those individual companies. And of course, a big contributor to that is how the different indices are actually constructed. So you have the NASDAQ, 5 positions account for over 40% of the total weight of the NASDAQ. And with those 5 positions having done really well, NASDAQ through the end of July was up over 20%, through the end of August up over 30%, because those 5 positions have done really well. Compare that to the S&P 500, which through the end of July was barely up, and the Dow Jones was actually down because they didn't have all those tech stocks. Just by way of illustration, 5 stocks, or if you take the 10 stocks across the S&P 500, the largest technology stocks, and just equally weight those, they're up almost 38% through the end of July. The other 490 stocks are down almost 8% over that same time period. So huge disparity in performance. And you take that even further, if you just take the bottom 450 stocks, so 90% of the S&P 500, those stocks are down well into double digits on average. So you might say they represent more of what's happening in the economy. But again, because you have just 5 stocks representing over 20% of the S&P 500, because it's a capitalization weighted index, they're really driving what's happening in terms of performance of what people consider as stocks, and not really representing what's happening in the broader economy. Certainly by traditional measures, it's hard to say stocks are not overvalued. By kind of your traditional measures of price to earnings ratio, stocks have only been more expensive twice in history, 1929 and 1999. Of course, both times preceding significant pullbacks in the market. And you look at it possibly even a little more concerning for returns going forward is that the Shiller PE ratio or CAPE ratio or PE10, all the same thing, basically looking at what earnings have been for the last decade across what the values are today, so much longer term focused, and that's in the 95th percentile, so again, very high, and again, strongly suggests when that's been the case in the past, returns over the following decade have been very poor. Yet today, things are different. Obviously, part of what's happening is people are looking past COVID, assuming that the market's going to recover. The other big thing is that fixed income is relatively unattractive, and so by that measure, stocks are actually still not expensive if you compare them to fixed income. So with the Fed promising that they're going to continue to keep rates low for an extended time period, it's possible that this could continue for a while. And of course, just because the fact that valuations are high doesn't mean that the market's going to come crashing down. Valuations can remain high for an extended time period, and that certainly could be the case now, given some of the strange tailwinds we've got with the Fed pushing the market higher. Yeah, for fixed income, it's going to affect it a lot, obviously. Rates are very low, no surprise there, everybody knows that. You look at what's happened though through this year and through almost the end of August, the Barclays Ag was up about 7% on the year, but 6% of that, or almost exactly 6% of that, was through price appreciation. So only 1% of that was through actual return or income. So certainly a lot of that's being driven by expectations, people fleeing into safety of assets. Looking forward, that really just can't continue indefinitely. So we've probably seen that, which means returns are largely going to be derived only through income. And with rates so low, we're not going to see that income be very strong. And with the Fed promising to keep rates low for an extended time period, we're not going to see that recover anytime in the near future either. So fixed income returns are likely going to be fairly poor. Possibly the only maybe silver lining in there could be the fact that it's unlikely that we see rates go up in the near future, so we're probably not going to see prices drop significantly in bonds. So for people looking for just a safe asset somewhere, at least in the near term, that probably will remain the case, and we won't see a lot of volatility in fixed income. You're just not going to earn much on your money. Yeah, COVID has probably not necessarily played out. There's certainly more surprises that can come out, but at this point, investors have a pretty good idea of what things could look like. We're certainly going to have surprises as earnings come out in different areas and bankruptcies and that kind of thing. Longer term, that could be something too, just the number of companies that are going to go under, and that's going to hurt the dynamism of the United States economy, and certainly global economy as well. But this fall, it's unless we have a vaccine come out that really surprises on the upside, probably not as big a deal, because we're not going to see a lot of, I think, significant changes from economic shutdowns and that kind of thing. So that's probably less of an issue. Elections are probably a bigger wild card. if Trump wins, we're probably going to get more of the same. Second chapter, but same book. If Biden wins, a lot more unknowns in that category. So with him, if he actually executes what he said is his platform and they get control of the Senate, or they move forward with really weakening the filibuster rules in one form or another and really kind of force their agenda through, we would probably see a recession and we would probably see some fairly significant economic pullback. But this is election posturing, so who knows what is actually, we don't know what's going to happen, and then how much of what is being said at this point is really what's going to actually be implemented. So you've got a lot of certainly promises that are made through every election cycle. This one's no different, maybe a little more unusual in that sense, but it's really hard to know what may happen if Biden's elected and how much of his platform does he really put in place. Like I said, the platform he's outlined is very anti-growth, but it's elections, so who really knows what happens with that. But there certainly would be more volatility just because there's a lot more unknowns if we end up with the Democratic Party taking over. Given where valuations are at and some of the volatility that could come, investors may want to look at diversifying a portfolio. That's kind of basic information, and yet investors kind of have a second chance if they were rattled by the market meltdown in March. They've got kind of a second chance with markets really having recovered very strongly. Valuations being very high doesn't mean the market's going to go down, but it probably would be wise to look at some other opportunities. Certainly private markets represent opportunities that are probably have different drivers than exist across the public markets. There's a lot more means to access that, whether that's through interval funds, different sectors, different approaches in one form or another, but that's certainly something that I think a lot of investors would probably be wise to look at. Just because markets could continue as strong as they are, but with a lot of the kind of unique circumstances driving things today, it seems that investors probably would be wise to look at a lot more diversification than what they've necessarily needed over the last decade.